Hi everyone, I'm Bridget Jennings, one of the directors of FAMANZ, and I would like to welcome everyone to FAMANZ's webinar on the ATO taxation ruling relating to deductions for expenditure on environmental protection activities and the HomeBuilders grant. Please keep your audio and cameras off during the webinar. We have two presenters today, Matthew Caruso from Matthew Steer and Stephanie Claydon from ASEA. We will hold questions until the end of the webinar. So in the Q&A, please put who you would like the question directed to. So first up, we have Matt, who is an associate of Matthew Steer and is a member of their private wealth division, leading the financial planning, tax compliance, and self-managed super fund teams. Matt holds a Bachelor of Commerce from La Trobe University, has completed the Company Directors course with the Australian Institute of Company Directors, as a qualified chartered accountant, holds a diploma of financial planning, and is an authorised representative of Australian Unity Personal Financial Services Limited. Matt will be discussing the HomeBuilder grant, which was put in place as an economic stimulus due to COVID-19. He will discuss the scheme, the eligibility criteria, and outline the timing of the scheme. Over to you, Matt.
Thanks, Bridget. So I'll bring up the presentation here. Just shift that over. All right, so the HomeBuilder grant. First, I'll just touch on a bit about Matthew Steer. So we're a firm 30 years operating and supporting clients in Melbourne's northwest, team of 50 staff. So as Bridget mentioned, focusing on business strategy and protection, wealth creation, and accounting and tax services. So in terms of the agenda for this part of the session, in terms of HomeBuilder, so what is HomeBuilder, the eligibility of HomeBuilder itself, run through some case studies, and then some frequently asked questions on the grant. So what is HomeBuilder? It's a time-limited program grant to help the construction industry bounce back from the COVID-19 crisis. So in a nutshell, eligible owner-occupiers, including first home buyers, can receive a grant of $25,000 to build a new home or substantially renovate an existing home. So in terms of who's eligible, so it has to be a natural person, so not a company or trust structure, aged over 18 and an Australian citizen, and meeting one of the two income caps. So applying as an individual, so an individual applicant on themselves, a taxable income maximum of $125,000 for either 2018-19 or 2019-2020 tax years. As a couple applicant, and I'll touch on in terms of what that means a bit later, so a $200,000 maximum for the couple for those same years. So a key point is in terms of entering into a contract between the 4th of June 2020 and the 31st of December 2020. So those key dates there. So to either build a new home as a principal place of residence, which does not exceed $750,000, renovate substantially, and I'll touch on definition of that in a moment, an existing home as a principal place of residence. So a key note at this stage is it has to be, your owner-occupied principal place of residence, so not an investment property. And the conditions on that are the contract is between $150,000 to $750,000, and the house and land value does not exceed $1.5 million pre-renovation. So just in terms of a third option there, purchase off the plan or a new home as a principal place of residence as well, where the contract price does not exceed $750,000 and construction had not commenced prior to the 4th of June 2020. So in terms of substantial renovations, so to be substantial, the renovation, I guess what they're saying is it's not standalone items. So it doesn't have to be, a foundation, external wall, interior wall. However, it has to improve the safety or livability of the property. But in terms of standalone granny flats, swimming pools, tennis courts, structures not connected, etc., do not count. And another key, I guess, eligibility item is that construction had to have commenced on or after 4th of June and within 3 months of the contract date. And Victoria, because of the ongoing COVID-19 issues, have an extension there, so it's actually 6 months in Victoria. So that's a key item there. The construction has to commence within 3 months of the contract date, and I guess the reasoning behind that is just to actually get things going now in terms of the construction market versus a longer time period. So what does commencement of construction mean? It depends on the type of contract. So for new builds, it's essentially, and it will also depend on each state in terms of when you're applying and on how that directly goes. But the commentary is around, for new builds, excavation and preparation of site works, substantial renovation, the works under the actual renovation contract commence, and for an off the plan, laying the foundations or slab. So in terms of applications, so how to apply from the relevant State Revenue Office by the 31st of December. In terms of payment of the grant itself, for new builds, after the foundations have been laid and the first progress payment paid. Substantial renovations where 150,000 of the contract has been paid, and off the plan new home after the applicant name is registered on title. So to touch on some case studies in each of the areas, which I'll run through. So a knockdown and rebuild. So that is one that's eligible. So in terms of this case itself, we've got Henry and Jackie, Australian citizens, combined income 170,000, so under that $200,000 threshold. Entered into the contract on 24th of August, so within that time period, valued at 400,000. And the value of the property is 800,000. So the existing value of the dwelling and land, 800,000. So in terms of the outcome for this one, so in terms of the different requirements that are listed there, they're Australian citizens over the age of 18, combined income under 200,000, and the value of the existing home is less than 1.5 million. So you'll note for the previous page here, the value of the existing property is 800,000, so below that 1.5 mil threshold. And the actual, the building contract for the renovations is between those, the 150 and the 750 also. So knockdown rebuilds are eligible. A substantial renovation. So in this case, enter into a contract within that time period up till December, with renovations valued at 400,000, so within that 150 to 750, and taxable income of 100,000, so below that 125 threshold. Value of the home 900,000, existing property, so below that 1.5 mil. So that in terms of those, and she's an Australian citizen as well, so falling within those different requirements there in terms of taxable income into the 125, the value of the renovations 150 to 750, house value less than $1.5 million. And and in terms of getting paid, the actual grant itself has made payment of $150,000 for the renovations. So building a new home on a vacant block. So that's another area where the grant is eligible. So Carla and Andrew are building a home on a vacant block, so that they already own themselves, so they actually own the block already. The value of the block is 400,000 and the building contract is 300,000, so in combination 700,000. They enter into the contract on the 4th of July and make the first progress payment when construction commences on the 2nd of August. So in terms of this one, they're Australian citizens over 18, taxable income under 200,000 combined, so they tick all those boxes there. And the value of the property a house and land is less than 750, so that was 700,000. Contract was signed after the 4th of June 2020 and below before 31 December, and they've made their first payment. So getting the actual payment when they've made their first payment as well. So meeting all those things. Purchasing a house and land package, this one's a fairly simple one. The contract's 550,000 on the 5th of September. So that is below obviously the $750,000 requirement there, meeting all the other eligible requirements being under 200,000 for income as well, over the age of 18 and Australian citizens. So another simple one here being an off the plan apartment, before the 31 December date, 550,000, so under the 750. So off the plan apartments being eligible as well. So in terms of some frequently asked questions that I've come across when discussing this grant with clients over the past few months. So meeting the income requirement, so the 125,000 for an individual and 200,000 for a couple applicant. So what if I don't lodge a tax return? If you're below the tax, so there's different reasons why you might not lodge one if you don't need to. So income below the tax-free threshold, etc. There's the option to lodge what they call a nil tax return. And that gets registered with the ATO, then that can be supplied as evidence of income to meet the income requirement. Good news in terms of the grant, is not actually taxed as well. So is the HomeBuilder grant taxed? No. If more than one person is listed on the title, so in that case, you have to actually jointly apply for the grant as a couple, then you'll fall under that second income cap, which is the $200,000 cap. And I'll touch on the next point. So what is the definition of a couple? So this includes couples that are legally married in a registered domestic relationship or living in a couple on a domestic basis. So that's those two link in, I guess. That's how that works, that the couple cap. And in terms of the next question around, I'm an Australian citizen, but my partner is not. So that precludes you from being eligible for the grant, because both members of the couple have to be eligible for the program. A couple of other items that, as I mentioned before, investment properties are not eligible and standalone granny flats are not eligible. Another couple of questions I've come across discussing with clients is around how does the $1.5 million value become assessed. So in terms of the guidance from the ATO around that is, that may be a recent contract of sale for the property, a rates notice, or a bank or an independent valuation. So, and some of these items also are relevant, I guess, in the tax world around proving the value for a lot of different reasons. So that's in line with that. But when applying for the grant, if you think that you're close around the $1.5 million value, I would be checking specifically with the State Revenue Office to discuss that issue to avoid that becoming a problem later. If construction is delayed due to other issues, the guidance given around the grant is that it'll be assessed on a case-by-case basis with the State Revenue Office essentially, and they'll assess what they can do in that space. Here is the disclaimer regarding all that we've discussed there. And thanks for that. Thanks for listening.
Thanks very much for that, Matt. Very interesting. We don't have anything like that in New Zealand. I can see how that would be very beneficial to some people. Next up, we've got Stephanie Claydon. Stephanie is an Assistant Director with ASEA, the Asbestos Safety and Eradication Agency. Stephanie holds a Bachelor of Environmental Engineering from the University of Western Australia and a Graduate Diploma in Public Administration. Prior to joining the Commonwealth Public Service in 2015, she worked as a contaminated site specialist for over 5 years, conducting asbestos assessments for WSP and Golder. In her role with ASEA, she focuses on policies to encourage the safe, prioritised removal of asbestos and disposal of asbestos waste. Stephanie will be discussing the ATO ruling, what environmental protection activities means, and the applicability of the ruling to homeowners who manage residential investment properties, including how the ruling relates to testing where asbestos is suspected, engaging a licensed asbestos removalist to remove and dispose asbestos, and replacing removed materials. Over to you, Stephanie.
Thank you very much, Bridget. I'm just going to share my screen. And thanks everyone for joining us on this webinar this afternoon. So as Bridget has discussed, I'm going to talk about the latest taxation ruling and how it is now possible to claim income tax deductions for expenditure on environmental protection activities, which includes asbestos. So I just wanted to start, for those of you who don't know, I'm from the Asbestos Safety and Eradication Agency. We were established as a Commonwealth agency in 2013, and we coordinate national actions to improve asbestos awareness and promote the safe removal and disposal of asbestos in Australia. So our aim, as is here on the slide, is to assist the prevention of exposure to asbestos fibres in order to eliminate asbestos-related disease in Australia by coordinating the implementation of the National Strategic Plan. So a number of useful facts that we use for asbestos: 3,000 products contained asbestos in Australia over the 1950s to the 1990s, and in Australia we consume 12.8 million tonnes of asbestos. 6,300 tonnes of asbestos waste is illegally dumped each year, and it's estimated that that costs about $11.2 million per annum to clean up. Another one is 4,000 people in Australia actually die of an asbestos-related disease. So that includes mesothelioma, which I think is around 700 a year, and that is 3 times the national road toll. The other fact we use is the World Health Organization does say there's no known safe level of exposure, just because asbestos is a carcinogen. So what is the National Strategic Plan? So in 2019, we released the National Strategic Plan for Asbestos Awareness and Management, and all the states and territories have signed up to that, and WA has signed up in principle. So the NSP ensures that there's a nationally consistent and coordinated approach to asbestos awareness, management and removal, and it outlines our phased approach to trying to eliminate asbestos-related disease in Australia. So I was really interested to come talk today about this new tax ruling and what it can mean in Australia as policy setting and some of those risks, and who isn't eligible to claim it. So incentivising asbestos removal is a key thing we want to do as an agency. 1 in 3 homes built between 1950 and 1990 contain asbestos, some kind of asbestos, whether that's fences, roofs, sheds, anything like that. So incentives are needed to encourage the safe removal of asbestos from our homes, and it is a key priority of what we want to do in the agency and under the National Strategic Plan. So asbestos in good condition is considered safe unless disturbed, and homeowners, because of that, tend to leave it in place rather than remove it. And the research we've done by the agency has shown that there is a case for government intervention to try and incentivise asbestos removal to get it removed, especially from homes. So on the 15th of July 2020, the ATO finalised the taxation ruling TR 2020/2 for income tax and its deductions for expenditure on environmental protection activities. It is applicable to landlords who manage investment properties and includes tax deductions for testing where asbestos is suspected, even if asbestos is not found, engaging a licensed asbestos removalist to remove and dispose of asbestos, and replacing removed materials that result in a minor degree of alteration and improvement. We actually put some, when the first taxation ruling came out, we made some suggestions, and because that asbestos is actually mentioned 19 times in the taxation ruling, So you can definitely claim for asbestos related. So the eligibility, expenditure which can be identified and specified, specifically allocated to an environmental protection activity. And asbestos is considered an environmental protection activity. So remedying pollution from site of a person's earning activity. So your earning activity is where the site gives you and produces an accessible income for a particular income year. So that could be a landlord earning rental income from a rental property. It can be a commercial landlord who gets commercial income from a commercial property. So, and it even includes, in some cases, if you run a business from your house and you produce an income from running that business at your house. So the incurred expenditure that you do claim must be for the sole or dominant purpose to conduct environmental protection activities. And the replacement of a pollutant material with a non-pollutant material has to result in only a minor or incidental degree of alteration or improvement to a building structure or structural improvement, and it can't result in capital improvements to the property. So in the taxation ruling, the environmental protection activities are defined as activities carried on by or for you to prevent, fight or remedy pollution, and to treat, clean up, remove or store waste. So pollution is broadly defined as contamination by the direct or indirect introduction of substances, noise or energy, and anything that has a harmful or poisonous effect on the environment. So, and then pollution is also defined as encompassing substances that may not have previously been considered harmful, but now are, and asbestos is listed as an example there. The scope of environmental protection activities also includes actions which are necessary to remedy the asbestos pollution. So that is can actually work if property has been high pressure hose on the roof and you need to do environmental protection activities on the site next door if there's asbestos pollution, or your site, or it's been impacted by someone else. Asbestos testing. So environmental protection activities may include identifying and testing for actual or likely pollution. So asbestos testing is included where asbestos is suspected. So obviously a question mark might be turned up if you're testing everything in the house where it's built after the 1990s and there's no thought that there could be asbestos in that house. But if asbestos is suspected in a property, asbestos testing can be tax deductible. So in the case of asbestos, testing is considered to be integral to the undertaking of the environmental protection activity, even if the pollution is not found. So that's really useful to note as well, is that these asbestos testing can be tax deductible, even if there's no asbestos, because asbestos has been detected, has been suspected. Testing is required to identify the existence of asbestos, because you can't know it's asbestos just by looking at it. It has to be proven through testing, and or the extent or actual or likely pollution. So it's good news for asbestos testing. Asbestos waste is also included. So asbestos waste is considered part of the environmental protection activity as long as there's a necessary connection between the pollution, the asbestos, the asbestos waste, and the site of your earning activity. So obviously you can't claim for asbestos waste that didn't come from your property or from the removal activity at your property. However, if there's a necessary connection, the testing, the removal, and the disposal would all be part of the tax deductible. This also includes the costs for transport and disposal at a landfill facility licensed to accept asbestos, and the pollution or waste could also be caused by someone else or could have been present before you engaged in your earning activity on the site. So if you purchase a property that is contaminated with asbestos, you would still be able to claim it even though you weren't the one that happened in the first place. You've inherited that issue, you're still able to claim it. So even if it was caused by someone before you or it's buried on site, then you can still able to claim it. The deduction is also available where the pollution or waste originating from your site has affected another site. So that's a similar case if there's a high pressure hose incident and the contaminants have gone from your site to someone else. The cleanup of all those sites can also be claimed under your tax deduction, which is a useful thing for cleaning up an environmental and conducting an environmental protection activity. So from a policy perspective, there's a lot of benefits in this tax ruling. The taxation ruling encourages investors to identify, remove and dispose of asbestos in homes they own. It prevents landlords from leaving asbestos in low socioeconomic houses where it may be impacting tenants and may require removal, and encourages them to think about the environment and protecting those people's health and removing it from those homes. So investors are also able to claim the costs as a deduction against their income tax at the end of the financial year. It incentivises safe professional removal, as you're required to use a licensed professional instead of property owners removing it themselves or using unlicensed professionals. Asbestos professionals can also sell their services to investors as tax deductible. So if asbestos industries or asbestos assessors and removalists understands the tax ruling enough, they can tell potential clients that this is tax deductible in these circumstances. There's a potential boost to the asbestos industry and a potential boost to removing asbestos from homes. We're reducing our asbestos legacy in Australia and the liability from this ageing asbestos material in our homes, and reducing further instances of asbestos-related disease in Australia. There's also reduced ongoing or future costs. So we've done some research that shows that there's a reduction in insurance premiums between houses and properties that have asbestos and don't have asbestos, and there's an estimated annual bill saving of 3 to 5%. There's also an increase in rental income, an uplift of around $5 per metre squared for houses that don't have asbestos compared to houses that do. There's a reduced cost from responding to emergency or unplanned disturbance of asbestos. So it puts landlords at ease that if they remove the asbestos and claim the tax deduction now, they won't then have to deal with any maintenance or issues in the future or any unplanned emergency disturbance. And that can include natural disasters, storm events, things like that. Reduction in ongoing repair and maintenance costs, and ensuring rental properties are safe and fit for habitation. There's also a potential reduction in tenant complaints regarding mismanagement of asbestos. The risks, there was always the risk of unsafe removal, even by licensed professionals, and the risk that that may then impact tenants, neighbours and the environment, but the promotion of using licensed professionals should hopefully limit that. In the event of unsafe removal, there's a potential future liability for landlords from an asbestos exposure event. We also need to consider tenants who are often uninformed about the risks. So if landlords are then removing asbestos materials from the houses when the tenants are still living there, they may have limited rights in those situations when the landlord proposes to undertake removal work. And they need to be properly informed. It's also difficult to engage with landlords and promote this taxation ruling through property and real estate agents, especially small family investors aren't aware that these things are around. So it's really for promoting it through taxation accountants as well as real estate agents. So this example is from the ruling itself. Angela is a landlord for a house with a dilapidated shed in the backyard. The shed is clad in asbestos cement sheeting that is damaged and could be potentially harmful to her tenants. She gets a quote from an asbestos removal company who safely demolishes and removes the sheds for $7,000. Angela can deduct $7,000 from her tax return. So it's good to see here that fences and sheds and stuff are also included. Another example, Craig owns a commercial rental property which he derives income. The roof contains asbestos cement sheeting, a pollutant. Craig wishes to remove the roof, which is currently in good condition, because he's concerned that it might be disturbed in the future. Craig engages a building contractor to replace the roof with a material of superior quality. So the total cost for the works is $20,000 and $9,000 of that is for asbestos roof removal. Craig can only deduct $9,000 from his tax return. He can't deduct the $11,000 for the replacement roof because this is considered a capital improvement. If he had replaced the roof with replacement material of a similar quality without asbestos in it, then he would be able to claim that amount for the replacement material. But considered he wanted to replace it with a better quality material, that was considered a capital improvement. So the third example, James owns a residential rental property, which he derives income. He engaged an asbestos assessor who discovers the walls contain asbestos. He then engages a building contractor to remove the asbestos sheeting and resheet the walls with a replacement material that is safe, but of a similar condition and quality. The total cost is $30,000. James can deduct the $30,000 on his tax return. The replacement sheeting is of similar quality and is not a capital improvement, as it only results in a minor or incidental degree of alteration or improvement. So that's some contact details there about our agency. Just this week we've launched our new website, so go check it out. And we've also got our email there, and we also run a public inquiries hotline about asbestos safety. Thank you very much, Bridget.
Thanks, Stephanie. Very interesting again. Something that I think New Zealand could benefit from also, actually. We do have some questions, and I will get to those. First, though, I just wanted to let everyone know about our upcoming webinar on the 12th of September, and that's regarding to managing the asbestos response to the bushfire disasters and how the inherent challenges of a statewide cleanup were managed without compromising health and safety of the community. So have a look out for that on the FAMANZ website under events and register for that if you're interested. So we'll move on to the questions now. I'll just see if I can pull those up. Or do I have to stop sharing my screen? I do. Okay, so a question to you, Matt. Where there is more than one owner, does it matter if they are joint tenants or tenants in common?
Yeah, thanks for that question, Philip. I've actually, that's not something I've seen in the literature where that would be an issue, and I've just had a bit of a look while Stephanie was presenting there, and I couldn't see any comments regarding joint tenants or tenants in common. That would be something, I guess, to check with the State Revenue Office for the relevant state to see whether that would be a problem, but it's not something that I've come across. I'm happy to chase that up and send back through a response at a later stage if you'd like that. But yeah, that's not something I've come across where that's been an issue for the HomeBuilder grant in any of the literature I've read.
Cool, thanks, Matt. Stephanie, do homeowners have access to the same benefits for asbestos material as landlords and commercial buildings? If not, why?
Because homeowners don't necessarily earn an income from that property, so there's no earning activity there.
Yeah.
So unless they're renting out a room or conducting a business, they're not earning any income from that property. So it's not actually eligible for homeowners generally. I will also say that Matthew has also researched the taxation ruling as well. So if there's anything else you wanted to add about the presentation or my answers, feel free to jump in, Matthew.
Yeah, I guess the only, to that same question, yeah, it is part of the ruling mentions that I guess the property has to be in relation to an earning activity. I guess the other comment I would make regarding the sole and dominant purpose test in the ruling is that if there was a dual purpose for the expenditure, whether that be, say, asbestos removal as well as a capital improvement, it's best to make sure that the invoices that you get drawn up clearly separate out what's what the amount is that you're spending for asbestos removal versus or waste removal versus the capital improvement. Otherwise, you may lose the entitlement to the whole deduction because the invoice doesn't separate out the different expenditure, so you actually lose the whole deduction, likely. So that's just the pointer there, that if you're getting any asbestos or waste removal work done, as well as doing some other things on the property, to make sure that the person who's doing the work clearly identifies the different work on the invoice, as well as dissecting out the amounts expend, and then I guess in terms of then providing that to your accountant or bookkeeper in that form, so then they can actually clearly state what's what.
Cool. Next question for Stephanie or Matt as well. When removing previously unidentified asbestos waste on a property, is there a cap on the quantity of waste that is eligible for a tax deduction, e.g. asbestos contaminated soil used as fill?
That isn't mentioned specifically in the taxation ruling. So I think in the case of potentially buried asbestos waste or fill, that would be classed as an environmental protection activity because there is a risk to human health from using a stockpile of fill in a backyard where a tenant is there, where it's an earning activity. So in some instances, I would see that would be eligible. I don't know what you think, Matthew.
Yeah, I agree. And there's no cap limited in the ruling. And I guess the point to that is because generally a lot of building works are capital. And I guess what this ruling, which means that the expense is depreciated over a number of years, which I guess what the ruling is trying to say is, no, we're happy to treat that, as a policy statement, that's deductible, that environmental protection work, and hence it's deductible, I guess, in the year that it's spent versus amortised over a number of years.
Stephanie, how was the increase in rental return for asbestos-free housing, $5 per square metre, estimated, please?
Yeah, so we got engaged in an economist firm to do some research for us in around the return on investment from asbestos removal. And so they did some research. I'll need to look it up, but the report is actually on our website. So it's a discussion paper about the return on investment from asbestos removal. So they looked and did some research asking around what the return would be on rental return. It was mostly focused at commercial buildings, but it also did look at residential as well. So I can send you the link, Philip. You can have a look.
Cool. Next one on the ATO ruling, Matt, I'll throw this one to you. Can the deduction be claimed by a business who have purchased a contaminated site, only asbestos contamination identified in the soil, and wish to remediate the site for the purpose of future development?
Yeah, one of the points in the ruling mentions it can be on a site where the entity was carrying on a business and you've acquired the business and you carry on the business substantially unchanged as your earning activity. I guess that would be the thing to check there, was whether the business is being changed on that site, where the ruling more talks about, you've bought the site, you've found asbestos, essentially as an example, and now you're remedying that. If you were substantially changing the purpose of that site, that would be an item for consideration as to whether you would actually be able to claim the deduction, or whether it would whether it would be deductible or the cost would be capital. So then otherwise it'd be capital then just as part of the cost, and then when you sell that property at a later stage, if it was property development, you claim it at that time rather than getting the claim up front.
Yep.
Another option is if there was like a shed or something where you had your business on the site and the contamination was in another part of the lot. I see you might be able to subdivide the lot and claim, like if you had the business or some kind of earning activity on that property, that might be possible. But that might result in an increase in your capital of the property. So yeah, that one might be a bit interesting.
So can working from home count as an earning activity?
Yeah, that's a good question. I think we're all earning, we're working from home
yeah.
at the moment. I guess I look generally, in terms of the whole working from home, if I take that in the context of the way the ATO generally looks at it, a lot of the working from home deductions regarding more what they call occupancy expenses around rates and interest and things like that are generally claimable when you're running your business from home, versus if you're working from home as an employer, it's generally only claiming those, you know, sort of home office type expenses and not the occupancy ones. So that's an interesting point, in particular in the time that we're in at the moment. But I guess that would more, I would see that more as if you're running your business from home, and there's a few more restrictions around that, versus just working from home as an employer.
Mm-hmm. And Stephanie, is there a requirement for the asbestos to, hang on, is there a requirement for, sorry, I just lost the question. Is there a requirement for the asbestos to be removed if the identification of asbestos is claimed for deduction?
There isn't that link there, but I think there's a certainty placed on pollution and cleaning it up in a certain time frame. So it isn't specifically said in the taxation ruling that if you claim testing and it finds asbestos that you then have to remove it. But because it is tax deductible, they're trying to incentivize you to remove it and claim all of that expenditure altogether. And I would say that if it's classed as a pollution and a risk to human health, that it should be done in a reasonable time frame.
Yep. And I've just got a follow-up question from Paul Corey. The site that he was referring to, asbestos contaminated soils, is derelict, a former manufacturing site. Most buildings are demolished, hence the soil contamination. It has been derelict for years, and aiming to be developed in a few years' time into residential properties. This would likely fall into the capital improvement box, wouldn't it? I'd say so. Yeah.
Yep. That's right.
Cool. Any other questions out there? All right. Well, I think that's the end of our webinar. Thank you everyone for attending, and thank you very much to Matt and Stephanie as well. Very interesting. And Janelle has also popped up a survey monkey there at the bottom too. So please fill that out to let us know how you found the survey and what sort of topics you'd like next time. Thanks everybody.
Thanks everyone.
Thank you.